Okay, thanks for joining me. Today I'm going through Accounting 1 Jan 2012 on the AQA papers. It's task 3, so basically I'm giving a list of balances from the books of account of Alison Novak for the year ended 30th November 2011. Giving a few bits of additional information which we're going to have to play around with later on. And we're going to have to decide whether these changes here will increase, decrease, or have no effect on the profit. And then I forgot to print the other page off, but you need to produce a balance sheet. So, first of all, calculate the adjusted net profit loss for the year ended 30th November 2011 by completing the table below. Show clearly by ticking the appropriate box whether each adjustment increases profit, decreases profit, or has no effect. The first one has been completed for you. So, there's not enough space here for me to do all my work, and so what I'm going to do is just use my own paper. So, working 1. I'll just go through the first one just so it sort of clarifies why it's increased and why it's increased by the amount it has in a sense. So, inventory stock for the 30th November 2011, so the closing stock, the stock at the end of the year, so this will be the stock that goes in our balance sheet, in our current assets, was incorrectly entered in the draft income statement at 52,980. So that's the number we're concerned about. The actual correct number is this one, 59,280. So first of all, I might as well just calculate the mistake. So just calculate the mistake by just doing the two numbers in one sum, which is 6,300, which is just basically the change in the table they've given us. So what's actually gone wrong here? Well, we've put in our closing inventory as smaller than it actually is. So to fix this, we're going to have to increase our CI, closing inventory, which is going to have a knock-on effect, isn't it? We take away our closing inventory from our cost of sales. So increasing our closing inventory is going to decrease our cost of sales. We take away our cost of sales from our revenue to give us our profit figures, so it's actually going to increase profit. So it's going to increase profit by the amount of 6,300, and basically that just proves it. Thought I'd just go through that quickly. Okay, so number 2. Rates of £3,360 have been paid for the full year ending the 31st of March 2012. So firstly, you'll notice that this date is after the date that we'll put on the balance sheet, so it's a prepayment. So first of all, what we'll do is we'll calculate the amount of the prepayment. So the amount of the contract or the expense, and times by how many months we've prepaid over the length of this expense, sort of the contract length in a sense. So we've prepaid December, January, February, March, so 4 months, and it's for a full year, so it's over 12, so it's basically just a third, and that comes to 1,120. So what do we do with a prepayment in the expenses part of the income statement? Well, with a prepayment we always take it away from our expenses, don't we? So first of all, it's going to decrease our rates, which is obviously going to decrease our expenses, because rates are part of our expenses. Less expenses means higher profit. We're taking away less from our revenue, so we're going to have an increased profit. So that just means what we're going to do is just tick increase by 1,120. That's a horrendous tick. I just made it worse. Okay, so working 3. So we've got a bad debt of 360. So basically, bad debt is just an expense, so we don't really need to do this chain sort of thing. Bad debt, it's an expense, we haven't included it, so it's just going to decrease our profit, isn't it? Yeah, so we'll just do minus 360. So next one is the rent. Whoops. So working for. The annual charge for rent payable on the business premises is £34,200. At the end of the year, 2 months' rent is outstanding. So if there's an expense outstanding, we have an accrual. We haven't paid for the full amount of the expense yet. So it's just the same method with the prepayment in a sense. It's the amount of the expense times by how much is outstanding, 2, over the length of the contract. Well, once again, it is a year. The annual charge, annual means a year. So 34,000 times by 2 over 12 is 5,700. So that's the amount of the accrual. That's going to increase our expenses. So it's just going to be increase our rent, increase our expenses. Increase our expenses is going to do the opposite of what we did with our prepayments, just going to decrease our profit by 5,700. So tick and decrease, take away 5,700. So it's fairly simple once you understand sort of this chain thing, how it goes on, how it sort of affects your profit, how things increase or decrease your expenses, or increase or decrease revenues in a sense. So working 5. The motor vehicle is depreciated using a straight line method, so the sort of the easier method over 4 years. The estimated residual value of the motor vehicle at the end of the 4th year is £4,000. So once we've finished with it, we still think it's worth £4,000, this motor vehicle. No depreciation charge this year has been included in the draft income statement. So basically, we need to calculate the depreciation for the year. We haven't calculated it yet. That's all that means. So, how am I going to calculate this depreciation? Well, it's going to be quite straightforward. So I'm going to use brackets. So my motor vehicle cost is 26,450. I'm going to take away the residual value, and I'm going to divide it by 4 for the 4 years. So if we were doing a reducing balance, we would use this provision, but we don't use a provision because we're just using the straight line method. We want the same amount of depreciation each year, don't we? So 26,450 cost minus this residual value, the value of the vehicle after we finished it at 4 years, and then we want it for 1 year, and we've got it for 4 years, so we have to divide that lifetime by 4. So that's going to give us 5,635. So it's just an increase in expenses, and you know the rest, decrease profits. So I'm just breaking it down here to make it sound a lot more understandable in a sense. So decrease by the amount of 5,635. Okay, so transfer from the savings. Okay, so Alison transferred £2,000 from her personal savings, so her own money, not the business's money, into the business bank account. This is yet to be recorded. So what has happened here? Well, we've put money into the bank account. So what we can deduce from that is the bank account increases. That's not going to affect profit though, is it? That has no effect on profit. That's more of a balance sheet issue, isn't it? But she's transferred money from her own account, so that's obviously capital. So capital account also increases. She's put more money into her business. And if she was to take that money away, that'd be drawing. She's taking money out of the business bank account into her own account, or maybe another account, as long as it's not related to the business. So bank, capital, don't go in the income statement whatsoever. So this is a no effect. So just make sure you take no effect because it is worth a mark. So yeah. So working 7, maybe arguably the trickiest part of this question. So discount allowed of 810 has been incorrectly credited to the discount received account. So this is a bit of like a reversal correction error we've made here. We've actually done something's good to happen to us. Discount allowed. We've received a discount of 810 when we've purchased goods. What we've accidentally done is actually increase the discount we've given to other people. That's what it says we've done. We've not actually done that in real life though, have we? Because this is a mistake in the accounts. So I think the best way to give this as to fix this is to draw a T account. So discount REC received. Discount received is an income. Incomes go up on the credit. Just like sales, up on the credit, down the debit. So how do we fix this? Well, we're going to debit, that's horrendous grammar, 810 to the discount received account. So what is this debiting? Well, we're decreasing the discount we received, so that is going to decrease profit. We're decreasing our income, aren't we? Because this is an income, and if we're debiting 810, we're going to bring that income down, therefore bringing our profit down, aren't we? What we also need to do is increase our discount allowed. Sorry for all the abbreviations, it just makes the video a lot shorter. Increase our discount allowed by 810. So we've had to fix this account, the discount received, and then fix the discount allowed as well. So the profit decrease, because we have to edit two accounts, it's simply 810 times by 2, which is just 1620. So what we have here is discount allowed, discount, decrease, and the decrease is by 1620. So what you're going to do here is just take this original figure up here, add, take, no change, take, and then you're going to get a new profit figure of 55,850 for 14 marks. So this figure now is obviously going to go into our balance sheet, isn't it? We've got the new profit for the year figure. So now then, we're now being asked to produce a balance sheet. So what we might as well do first of all is calculate the this additional information. Some of these things we need to calculate before we put them into our balance sheet, don't we? So we'll just do our work. It's basically just go through the workings again like with any other conventional balance sheet. So working one. Let's just reiterate that our closing inventory actually isn't the figure given to us in the additional information. It's actually the figure up here. So 59,280. Working 2. So rates of 3,360 have been paid for the full year ending the 31st of March 2012. So what we did here was calculate a prepayment of 1,120. Also, you'll notice I don't need to calculate the amount of the what is it? It's a rates expense. I don't need to calculate how much the rates have come down by because I've already calculated the profit. You see, I don't need to. Usually, when you do something like this and they tell you to make an income statement and a balance sheet, you need to work out the amount of the prepayment, and then amount that the expense is changed by to get a new expense figure to put in your income statement. But I don't need to do that, do I? Because I've already got my profit figure. I've done the income statement, haven't I? They've just given it me in a shorter way, in a sense, haven't they? So that's that. So working 3, a bad debt. Well, we don't need to treat that as an expense anymore, but we can treat it as decreasing our trade receivables. So our trade receivables here are 9,830. Take away the amount of the bad debt, 360. It's going to leave me with £9,470 worth of trade receivables, people who owe us money, current assets. So annual charge, this is the outstanding expense, that's just an accrual. Already calculated that as being 5,700. There we go. Working 5. So we didn't need the provision to work out the depreciation charge for the year, but we will need it to work out the net book value of the asset. We need to work out how much it's worth now on our balance sheet at the end of the year. So we're going to take the cost, that's wrong, net book value equals 26,540 minus the provision 11,270 and take away the expense charge for the year. So, well, I calculated that, didn't I? I calculated the depreciation charge for this year is 5,635. So the new net book value of our motor vehicle is 9,635. So that'll be going to our balance sheet in the non-current assets section. W6. So this didn't change our profit in any way, did it? So we're definitely going to need it for the balance sheet, aren't we? So Alison transferred £2,500 from her personal savings into the business bank account. So we're going to have to edit our bank. And our bank is in overdraft right now. Negative 6220. Negative 6220. Add on 2,500. So it's still going to be in overdraft. So 3,720 negative. And we've also increased our capital, haven't we? Like we said earlier. Bank account increases, capital account increases. So, new capital figure. Capital account at the start of the year was 21,220. I'm just going to add 2,500 on again. So that's going to give me a capital figure of 23,720. Also, this highlights the whole how the whole T account system works. If you look at the bank account, up on the debit, down the credit. I'm just doing this as an example. This is not part of the question, but it just highlights how every transaction has a debit and a credit. It just highlights it so well. Capital goes up on the credit, down the debit. So what has happened here basically? Well, with this working 6, we've debited our bank 2,500 and we've credited our capital the exact same. So it just serves to show how it's a very easy way to show how every transaction has a debit and a credit. It's just really well thought out, that point, I felt. It's quite a nice example of how it works. So anyway, moving back on to the actual question I should be answering. W7. Well, discount allowed, that's to do with sales, isn't it? Which goes into our income statement. How much discount we've allowed. So it's an expense, isn't it, in a sense? It goes in our expenses section. Discount received, that's an other income we add to our gross profit. So that's going to have no effect. So now what I can do is, with these workings, is just go onto my balance sheet in a sense and just work through that now and get that done. So as always, you need a title. It's always worth a mark. It can be a bit tedious and it's always, I always used to forget, but that one mark is always potentially worth an extra grade in a sense. So balance sheet for Alison Novak as at 30th November 2011. My handwriting today is terrible, I apologise. So we have one non-current asset. And that's the motor vehicle. Just one motor vehicle, singular. And I calculated that as being worth 9,635. So 9,635. I'm just going to put a line over the top of it just to show it's the only non-current asset we have. So now onto our current assets. So there's 3. Quick question, can you pick out the 3 just by looking in there? You can probably pick them out quite easily. So it's 3 very traditional current assets we're looking for. One is the closing inventory, one is the prepayment, and the other is this. Well, it's not the bad debt, but the bad debt shows you that it's actually the trade receivables at the top here. So my three current assets are my inventory from point 1, my prepayment from point 2, and my trade receivables, which point 3 shows. Well, the bad debt does sort of show we have trade receivables because we can't have a bad debt. Someone can't owe us money. They have to owe us money in the first place to be able to say, oh, we can't pay you back, don't they? So you have to have trade receivables in a sense to have bad debts. So the inventory is worth 59,280, the figure with the star next to it. The prepayment I calculated as 1120, and the trade receivables I calculated as 9470. So all my current assets come to 69,870. So current liabilities, there are no non-current liabilities, thankfully. Not tricky, but it can just be a bit tiny. The first one you can notice from the list of balances, the trade payables. We've got an accrual. We've got a bank overdraft still, don't we, from the 0.6 I calculated earlier. And if you'll notice, just above the bank overdraft, we have a bank loan repayable October 2012. So how do we define current liabilities? Well, it's anything where money is going to outflow within the next 12 months, in a sense, isn't it? And a non-current liability is after 12 months, longer than 12 months. So within a year of this, it'll be the 30th of November 2012. October 2012 comes before that date, so the bank loan is within the 12-month boundary, so bank loan. There you go. So trade payables, 15,740. The accrual is worth 5,700, which I calculated in 0.4. Bank overdraft, we calculated that in 0.6, and the bank loan was worth £8,400. Very often in questions you'll get a bank loan where half of it is a current liability and the other half is a non-current liability, so make sure you do differentiate that, because if you did put the full amount into, say, current liabilities and non-current liabilities, it will still balance at the bottom, but your presentation will lose marks in a sense because you haven't presented it correctly in a way. So net assets, which is just all my assets, take away all my liabilities, comes to 45,945. So hopefully this now is going to be the same figure as what's going to come out at the bottom here, which is my equity. So the first figure is capital, then my net profit, which we calculated previously, and then my drawings. So the capital figure calculated in 0.6, 23,720. Where are we? There we are. Net profit, that's actually from the actual question paper, 50,585. And the drawings, well, the only things we actually haven't changed. Drawings is this 28,360. 28,360 taken away from the equity, which brings me to 45,945, and that is it. Hopefully this has helped you if you've been stuck with this question, or maybe just helps you revise something. But besides that, feel free to email me with anything that's AQA accounting related, and I'll see you in the next video.